Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about. Obviously, I'm going to interject my financial opinions across the board. It's going to be commodity, stock market, wealth building related topics. So let's dive in here and see what's going on. Again, it's at finding_finance if you want to follow me, and finding-value.com if you want to join. We do have a discount. It's called discount in the coupon code. So the dividend dominator. Now, this is one thing I don't understand, guys. I don't understand this. I'm starting to see this come up all the time. This person says, I'm 26 years old and I'm currently $13,000 away from reaching $100,000 invested. Also, my dividend income just passed $2,500 a year. Why do people need or feel the need to tell what people have invested and what their dividend income is? Why are they posting this? I mean, if I'm a person like myself and I'm reading this, why do I need to know this? Why are they doing this? Like, what's the whole point of it? Is it like to show the progress that this dividend dominator is having? Like, I don't understand the reasoning. Should I be posting my gains up there? Be like, hey, look, I just gained some amount of money. Like, what's the purpose? I try passing on knowledge. I try passing on what I'm seeing in the markets, interesting forms of data. But this data here, and I'm seeing it everywhere. It's like a big trend that everybody's trying to post what their net worth is, what their dividend amount is, and all this stuff. And I don't understand it. Maybe I'm the oldest millennial. Obviously, this guy's a younger millennial. I'm guessing. I think 26 is towards the young end of the millennials. I just don't understand it. I don't know. Or maybe it's Gen Z. Who knows? Obviously, got the midweek update up. It says Dave Ramsey is responsible for the largest study of millionaires ever done. Conclusions from the study. Most millionaires were in their plus 40s with paid off personal homes. Most millionaires contributed to their 401k plans. Most millionaires shared a bank account with their partner. Most millionaires on average made less than $100,000 yearly. Most millionaires never took a business loan, and most millionaires are self-made. Someone said down here, I think he said, Twitter, you don't understand that 90% of adult Americans aren't millionaires. Cheers to all those millionaires and props to you for the low blow. And then he says, if this is a flawed study, why has no institution debunked it? Well, we can try to debunk it, but I'm just going to say some things that are obvious to myself. So what Dave Ramsey did is he did a large study of millionaires looking backwards. Looking backwards means you're looking at people that are 40 or 50 years old and seeing the traits in that type of millionaire to see the traits that millionaires all had. Millionaires, my guess, are probably savers and somewhat intelligent to highly intelligent. There's a link between how much money someone makes and their IQ. Their profession is linked to their IQ. Their credit score is linked to the IQ. They even give discounts for better drivers. And drivers, they try to gauge what your IQ is to figure out basically if you're more responsible or not. And responsibility is linked to IQ. I'm not saying 100%. I'm just saying in general. That's why if you were looking at insurance companies, they give discounts to those students who have higher grades. They think, well, they see them as more responsible as a group, not as individuals, but generally speaking, that people with higher grades generally make better decisions, which generally reduce or result in reduced crashes. So when I look at this and I look at this overall thing, these people made their money in a declining interest rate environment. When you buy a house and you have a high interest rate, you have a couple of options. You can either refinance or you pay off the loan very quickly because the interest rate is a high interest rate. My parents, they fit in this. They are multimillionaires. They've made over 100 grand when they were working. They retired. They're older. A lot of older individuals fit within this. They paid off their home quite quickly. They had a high interest rate. Now, I also fit in this. I just turned 42. I fit in this camp, and I do not have a paid off home. I purchased my home at the bottom of the interest rate market. I'm going to let inflation eat it away. I will pay back less on my loan than what I took out on the loan in real purchasing power dollars. So if I take a loan out and whatever the loan of the value, I'm just going to make a round number. If it's $200,000 loan, I'm going to pay it back in 30 years with dollars that are valued less than $200,000. The total amount, it's your principal plus your interest, is going to be valued below 200 grand for the purchasing power of that money, with inflation at a greater rate than my 2.75% loan. Now, this study is not going to accommodate that. It's not going to accommodate people like myself and a lot of people who I think are pretty smart, and they know that if the inflation rate is greater than your interest rate, that you don't want to pay it off completely. You'd be better off stacking cash into investments and let the inflation eat away. So there's one flaw in the study that I can tell right off the bat. And the flaw is they're looking backwards at what millionaires and the traits of millionaires have, what they did, and then they're trying to say that we should be doing that going forward. Now, if you have a high interest rate on your loan, I would definitely pummel that thing down. I would pay it off as quickly as possible, just like these guys did. So the traits are probably all the same. The personality traits, the job, probably the similar jobs and all that stuff. I do contribute to 401k plans. I do that to reduce my taxable income. I used to do Roth 401ks when I didn't make as much money. And then I transitioned into traditional IRAs or traditional 401ks pre-tax as my income grew and my dividend income grew and all this other income grew. It says most millionaires share a bank account with their partner. I actually don't share a bank account with mine. Her credit score was absolutely horrible in the beginning of our relationship, and I turned that around. She wasn't a very good financially savvy person. I'll just say that. And then, yeah, all of that. And I don't have a business loan. I don't have any of that stuff. Scrolling down, we've got mortgage rates near 7%, house price growth reaccelerating, affordability getting squeezed in the US. So one of the best things I've done in my life is lock in one of my largest expenses, which is where you live. I bought a house back, I don't know, whenever, and I refinanced it at 2.75% in 2021, I think. And you can see here that the mortgage payments, if you look at a conventional purchase loan size, and then you look at the payments going across here, you can see that the payments are $2,250. Up here is $3,000, $3,000. Mine is like way down by below this chart here. It's below the $1,000 is my mortgage. My food costs for my family is actually more than my mortgage now. And one of the best things I did was lock in my mortgage and get it at a very low rate, a very low payment. And I'm just going to let inflation eat it away because I just don't care about that. I don't even know what's left on my loan anymore because I never go in that account. I just let it take that amount out of my account, and I don't even really think about it, to be honest. I haven't gone in there for at least a year, and I don't even know what the loan value is anymore. So I don't know. That's my take on it. My credit card bills they're definitely far more than my mortgages. And that is really what I'm trying to focus on is how can I save money? How can I reduce my expenses from that aspect? And my mortgage is fixed, so I can't really do much with it. I don't spend much time thinking about it, to be honest. But I could definitely feel the pain here. Hopefully those guys that purchased homes in 22 and 23, if they do have a mortgage payment, that they can refinance later. And you can also see that the mortgage values, this is like 400,000, 500,000. They're taking 400 and something $1,000 mortgages out, is what it looks like. I know I didn't take that amount out, not even close. But that is an interesting fact here. And the best time to buy a house was 2011 and 2012. Those are the best times in terms of affordability. Was 2011, 2012, which is the bottom of the housing market. URNJ, back to the outline. So this is URNJ. You can see it is a cup and a handle that's ready to break to the upside. Now, I've talked about this on the website. Uranium Junior mining companies might be a good thing to be looking at them. And here it is right here. This is a 2-hour chart, so it's pretty much a shorter term time frame. Now, this isn't technically a legit cup and handle because cup and handle charts are generally a continuation pattern. They usually come up, so it could be a cup and handle if we had more data that came up like this and created it, but it is a good pattern either way. We've got support going across here. We're still above everything. Looking at Grady, many are worried about miners lagging the metals. Miners always lag the metals from big lows. It is not a worrying problem. It is an opportunity. One can play a resume bull with a bearish mindset. Do join the service for this commodities bull. So when you look at this, you have to look at it from a bullish perspective. And when I talk about all of these charts we look at and all of the data, that is what creates the bullish mindset. Then you look at these charts, you say, this is a false breakout. It can't possibly stay down here forever if we have the right market conditions for this to change. So what he's got here is very probable false breakout on the making and end around the apex move incoming, my own term. Breakout and back test for SILV. SILJ still lagging, but ready to break, and it's squeezing up. I think that Grady is a pretty bright individual. This guy's been around the block. He's calling this correctly, and I do think this is a false breakdown. So what does that mean? It means it's an opportunity, and I agree. This is where money gets made, is you take a stance against everyone else when sentiment's poor, you buy it, and then you just hold on, and you accumulate the asset. A lot of people try playing the short-term little market timing movements. I don't play that game. I used to play it back in the day. I did not make hardly even close to the amount of money I make today. I'm talking about percentage terms, baggage terms, whatever you want to do. It's just not the best way to do it. The best way to do it is to identify where the value is in the market, accumulate the value. Cost average in is what my approach is. You use the charts to get you as close as you can to the ideal buy points. You get that nice bullish mindset behind it. You change the paradigm. Commodities are in a bull market. SILJ and all of these different precious metals are going to go up in that commodity bull market, and you buy them when things are very cheap. That's how you get 10, 20, 30, 40, 50 baggers. You cannot wait for breakouts. You cannot wait for momentum from the price side. Some people can argue, oh, it's less risk. Oh, the time that you have to wait. I just don't see the returns like I do if I buy super early, even if I have to wait on some of my positions for a few years. And then the cost basis is so stinking cheap that when it does go up, you get massive amounts of returns. The differences could be a 5-bagger versus a 50-bagger. And you just can't make that difference up by buying at bottoms and being a little bit more patient. You just can't make that difference up. It's too big. It says energy companies just reported the steepest decline in operating rigs in 3 years. The lack of urgency among these businesses to boost production is paving the way for another strong rally in oil and gas prices, ultimately creating further upward pressure on inflation. He is correct. We also saw from other charts that inflation's breaking to the upside. We've got oil breaking to the upside and all these different commodities breaking to the upside. And at the same time, we've got U.S. and oil and gas operating rigs, steepest decline in 3 years. We've got COPX, boom. Copper miners ETF on the cusp of a huge breakout to new 2023 highs. Is Dr. Copper smelling something bullish in the global economy? Big demand for base metals needed for global infrastructure upgrades. Keep your eyes on the copper stocks. And I own SCCO there. This is ready to break to the upside. Big old move when this breaks, guys. Lots of resistance up here. And when we finally break, we could get a huge move to the upside in the copper companies. Coming down to Happy Hawaiian, he says, love this chart, though in my mind, passive stocks and bonds should basically be no hassle. Real estate around a 6-7, and owning a business is a 10. Also think it should be even steeper, as in you need to require even more return to make the hassle worth it. So this is the return hassle spectrum. We have difficulty hassle, expected annualized returns. T-bills, US bonds, diversified portfolio, 60-40. Passive stock fund, active stock fund, individual stock picking up at 8. Real estate rentals and starting your own business all the way up here. I also think that if you start your own business and you actually know what you're doing, this could be a far different number. Same with, depending on how you do it, real estate rentals and when you purchased and what it looks like today, because your returns could go up quite substantially. I think it's harder for these returns to go up a lot more than it is for these returns over here. You could have multiple hundreds of percents in annualized return for periods of time starting your own business, starting from nothing, going to something that you've built. So there is that in there as well. We've got Meta. Meta has broken its uptrend. This chart here looks the exact opposite of commodities. Commodities is pointed downward and it's breaking upward. This is pointing upward and is breaking downward. Technology and commodities move inversely almost, given where interest rates are probably heading. The M2 money supply keeps expanding. So we do have that. It keeps coming on up here recently. That's something that people were worried about because the M2 money supply was coming back for a little bit. Shabam says 2 billion people represented by these 7 countries, all on the right part of S curve and all with significant growth in petroleum consumption. At the same time, their combined crude oil production remains in terminal decline, a growing import requirements for years to come. So here's production. You can see it's rolling over from early 2000s, and you can see consumption of oil production drastically increasing. That means larger imports from other areas. My question is, where are those imports or where are those exports going to come from? I don't know. This is going to be easy. This is going to be an interesting future. This is from crude oil peak, which could be the case. Anyone that locked in new low mortgage rates on their primary homes knocked off 10 years of needing to work. Yeah, I agree with that. Housing price index in the U.S. lodges new all-time high. So much for housing disinflation. The U.S. government to world. We need more suckers to cover our debt. BRICS, eat your heart out. U.S. Treasury issues 4% worth of 2022 USA GDP in new debt in 1 month. LOL. Interest expense on that new 1 trillion likely to be 25 to 30 billion. And there's the new U.S. debt of 1 month and how it stacks up against the U.S. GDP 2022 full year. We are increasing our debt issuance with time. It's getting ridiculous. Buffett's back to buying more oil and gas stocks despite the ESG push. Warren Buffett spent billions on oil and gas investments early in the pandemic. Instead of selling for huge profit, he wants more. I agree with that. Looks like he's seeing what we're seeing, fellas. A back test to that trend line and a break higher with the oil stocks being at incredibly good valuations. such an opportunity to change your life here, to change it for the better with these investments. Bitcoin's trying to reverse its breakdown versus inflation. It has not yet succeeded. Here it is. We've hit our head. We broke the upper trend line, and we are below it. And where are we going to go? We're going to go back up, or are we going to head back down? I don't know how Bitcoin reacts to inflation. We've never seen this dynamic play out for a long period of time. It's possible that Bitcoin behaves like a technology stock, and when interest rates go up, Bitcoin falls. Again, I don't know which direction this is going to go for Bitcoin. And to me, by looking at this long-term chart, we could see this break lower, which is a probability because we've broken that uptrend key support line. Gold is a proven long-term hedge against inflation, but shorter term, it can deviate. So want to see gold outperform the CPI, Consumer Price Index. And that is a clean breakout for gold versus the US CPI. Plus, now a good-looking backtest in the making. So we could see a big move in gold versus the Consumer Price Index. And I think the Consumer Price Index is about to increase here. Breakout from a 2.5-year bullish expanding falling wedge plus a backtest. Bankrate says, to feel comfortable, Americans think they need a $233,000 salary and $1.3 million for retirement. I think the salary figure is high and the retirement is too low. What do you think? Well, what I think is to feel comfortable, I think he is correct. I think this salary is probably too high, and I think this amount of the amount of dollars in retirement is too low. What I would say is I don't care as much about the salary. I would say for this amount, at my age, in retirement, I would feel comfortable with is like a $3 or $4 million figure. 1.3 is too low. I mean, a $233,000 salary is absolutely fantastic. Definitely take that, but I don't. To feel comfortable, the word comfortable, I don't think 233 is the correct number. I think it's a little bit lower than that. Definitely, this does not feel comfortable to me for retirement. That's too low of a figure. I'm sorry. Energy is the cheapest sector in the S&P 500 and makes the most cash. That is where you want to be, guys. Why do you think Buffett's jumping into this? Makes the most cash and it's the cheapest sector. And I'm loaded in it. Don't get me wrong, guys. I'm loaded in that sector. Major fiat currencies are in a losing parabolic run versus gold. The FX pair charts does not reveal the debasing of fiat currencies. Inflation is eroding our purchasing power. All below have made new highs, and gold in USD will follow. This is Australian dollars, parabolic move, Canadian dollars, parabolic move, British pounds, and euro, all parabolic moves of gold priced in those currencies. Gold is gold. 1 ounce of gold is 1 ounce of gold. What is happening is the currencies are getting decimated. That is what's occurring. And it's going to come for the USD next. This is the chart of the 30-year expectation for inflation by the market. It's probably one of the most bullish technical setups that I've seen. Major breakout followed by 2 years of consolidation. Just when investors believe inflation was behind them, it is starting to show its teeth again. So here's the downtrend line. We've broken out. We've consolidated, and we're probably going to move higher. He's talking about yields on the 30-year. The 10-year is also looking like that as well. Another Grady chart, he says, now this chart is showing a confirmed huge breakout for silver versus the S&P 500. And the second big backtest in the making. Big changes happen slowly, then it goes even faster. Historical massive asset paradigm shift. Here's the shakeout. We're about to break here. This is silver versus the S&P 500. Again, on the website, we've talked about silver. We've talked about precious metals. We've talked about the gold and silver mining companies and where they're located. They look G-O-O-D, good. This is Patrick Karam. Difficult concept to grasp. The more your wages go up, the more your purchasing power goes down. Crowd is getting fooled by the fiat currency illusion. Gold and silver will remove the illusion. help share and spread mass awareness. This is United States purchasing power since 1964. This is the 7-year rate of change in red. This is the 7-year rate of change for wages. Wages go up, but the purchasing power rips to the downside. Silver goes bonkers, and gold and platinum under these market conditions. We're in, I can't even find something that is a market condition that's showing negative for gold and silver on a long-term time frame. In the short term, yeah, anything can happen, whatever. But longer term, guys, everything's looking very good from that perspective. So that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel, subscribe to the website. Let me know what your guys' opinion are. What makes you feel comfortable for a retirement amount and an income? Put it in the comment section. Love to hear your guys' opinion on that. For me, I think a comfortable salary is something like 150. That would be pretty comfortable. And then I think from a standpoint of how much money for retirement, a comfort. When I think of comfortable, I think 2-3 million at least if you're at retirement age. If you're retiring early, I would definitely say it's more than that. It's probably 4 million if you're going to try to retire early and draw it out longer. So I know that may have some sort of implications when you think retirement. Obviously, it's highly dependent on what age you're talking about starting your retirement. But that's what I've got for today. We'll catch you guys later. This is Finding Value.